Welcome to my channel. I'm the cover call guy. My goal is to create a $120,000 per year passive income using only cover call ETFs. My portfolio currently yields about $70,000 a year and about $6,000 a month. Legal disclaimer before we start this video. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online and I could be completely wrong. Now, with that out the way, today we're going to be discussing Ray Dalio. He mentioned today on the news that he said we're 80% into a full-blown AI bubble. He believes is not. He believes this is what's causing the part of the reason why it's causing the market meltdown. So we'll be talking about navigating late cycle markets and next gen ETFs, a structural analysis of valuation, risk, and opportunity, because there is always opportunity in times of crisis. Right, when people panic, that's when you get greedy, and this is a time to start getting greedy because people are panicking and selling, panic selling. As you can see, people are just completely emptying out and just walking away. We are at a market all-time high. Yes, the past 3-4 days, the market has been melting, but we are still up for the year to date. We are still at an all-time high. So, do we have more? Do we have more percentage to go down? Probably. We will probably see a little bit more pain than before we see the upside, but don't panic. You shouldn't panic, especially if you're buying for the long term. I am going to be buying. I will be showing my buys at the end of every month. I think that's better instead of every week or so. I think every month would be better. I would be buying all of the dip, as much as the dip. I'm here for the long term, so I am not panicking because I want to increase my cash flow. Right, cash flow is king. So let's just talk about what he says, and then I'll go into some cover call ETFs that I think you should be buying and start restructuring your portfolio if you don't already have these ETFs. So let's get into it. All right, the macro thesis, Ray Dalio's 80% bubble warning. This just talks about what he thinks is happening, right? His bubble gauge. Ray's talking about, he indicates that the U.S. equity market is 80% of the way towards historical peak. Critical warning signs include valuation extreme. S&P 500 Shiller CAPE ratio is above 40x, a level seen during only dot-com peak. So he's comparing it to the dot-com bubble. And then discounting perfection. Markets assume NVIDIA's 57 billion revenue plus 62% year over year will proliferate effortlessly across the S&P 500. And then, of course, the retail, right? The brokies like us, we're the retail, right? The record naive capital leverage via options and AI favorites. So he thinks that retail is way over leverage in AI/tech, right? And then his quote saying, "We haven't reached the perfect storm yet, but the structural integrity of the rally is compromising." So he thinks this is part of the reason why. He's going back on the historical metrics of the dot-com bubble. He thinks it's going to pop, and we are if it's not already popping, then we are like 80% there. But reading the article, I kind of put together that 10 reasons why he might be right and why he might be wrong. 10 reasons is what he listed. The CAPE ratio is above 40. That just means historically predicts low negative for 10-year returns. Retail option frenzy, right? Naive money, aka retail, aka regular guys like you and I. Naive money is leveraging up, creating fragility. Hyperscaler return on investment gap, right? 400 billion plus AI spend versus minimal realized software revenue. So there's just saying they're spending a lot more than they're actually bringing back in. Inventory double ordering. Chip demand may be inflated by panic buying, such as the NVIDIA chips. Wealth tax risk policy change could force billionaires to sell. So the big whales are probably trying to take in as much profit as much as possible. So that is causing the downside right now, the downturns in the market. And then he says divergent economy, Fed easing into an inflated asset bubble, concentration risk, insider selling, geopolitical friction, and yield curve dynamics, which just mean bond volatility signals underlying economic stress. And then I'm just predicting 10 reasons he might be wrong. I'm saying a productivity miracle. AI could boost GPD significantly, justifying multiples, right? Obviously, right now, we are in a scaling phase. We are trying to improve AI and we're trying to scale it. It's going to take some time. Strong earnings, right? Big tech is printing record free cash flow unlike 2000 because big tech is actually, we technology is part of our life. We're not getting away from it. Everyone uses it. Cash on sideline, about $6 trillion in money markets could rotate into equities. So we have $6 trillion on the sideline, right? People, companies, billionaires, millionaires are holding about $6 trillion as dry powder. That has to go somewhere, right? The Federal Reserve signal willingness to cut rates, and once they cut rates, that $6 trillion will move somewhere. Rational bubble, infrastructure build out often look like bubbles, but last. When everybody says it's a bubble, then it's not a bubble, right? Bubbles happen when nobody's predicting it and kind of screaming, "It's a bubble! It's a bubble!" Broadening breadth, rally, rotating from tech to industry, small caps, right? It's just a rotation. That's what I think it is. A lot of people are just going back into value and growth instead of speculation. Corporate buybacks, right? Record buybacks provide a price floor. U.S. exceptionalism, global capital flows to the U.S. as cleanest dirty shirt, right? So it's a whole cycle coming back to the U.S., which I think will happen. The investments from other country, intangible assets, accounting rules understate software value, inflating PE, and then momentum. Market can stay irrational longer than you can remain solvent, right? Just the great, I think the great Charlie Munger said that. The income dilemma, right? Why traditional strategies fail and bubble, and why we are going for cash flow is king. Again, this is a cover call channel, and if my viewers, subscribers, if you're into cover calls, this is what we should be doing. This is how we should be rotating and strengthening our portfolio. One, this is just illustrative purposes, right? We are I'm putting a chart on what could happen and how it could happen and how it affects us, the cover call / income investors, right? So the bubble expansion is the melt up, high IV, upsize capped, total return impact, underperformed significant rallies due to call ceiling. That's okay. We're here for the income. The bubble burst, it crashes. Income, very high, upside capture, none. Total return impact, drawdown occurs. Premium offers partial buffer. We're fine. The prices will drop. It's going to happen. It's going to match with the underlying, but we will get income from it. The early recovery stage, right? Market is always going to recover, right? The economy is always going to recover. The USA is always going to get back on its feet. Income, moderate, upside capture. Depending on what you hold, it will lag. Total return impact struggles to catch up as calls get tested. And then sideways stagflation, income moderate, upside capture optimal, and total return impact outperforms by monetizing volatility. So these are the 4 phases. This is how we us cover call / income investors will perform in these 4 phases. So don't freak out. The risk reward calculus, right? The yield trap risk, right? Capped upside, missing the final 20 melt up can be costly. Principal erosion, how you cannot offset a 30 to 50% crash. Tax efficiency, ordinary income rates such as ELN drags returns, and liquidity panic. Broad selling can disconnect NAV. Strategic opportunities, volatility harvesting, right? We have a good, if you hold good cover call ETFs, it will harvest all of these crazy panic buying, selling, whatever it's happening. Right, selling expensive options to naive buyers. Cash flow, reduced reliance on capital appreciation, diversification, broad exposure mitigates single stock blowups. Partial hedge, premium acts as a shock absorber. All of these are good. All of these we got to capitalize on. This is why I always say hold good cover call ETFs. My top tier solutions, next gen ETF. some tax efficiency, dynamic deltas, and quality. Okay, some of these are just things that I would buy and I would hold during these uncertain economic times, and definitely hold during great times. So they are my buy at any given time. So far, these has been great. They have a good strategy. They come from good funds. They look like they know what they're doing. The first one is the NEOs, right? The NEOs approach. SPY, QQI, the most two popular one, but they do have other ETFs that I do plan to buy. These are just examples, right? So one, these solve the capped upside problems of first generation cover call ETFs, right? The structure uses section 1256. The strategy implement call spreads, short call plus long out the money call. Result, if the bubble melts up, the long out of the call money allows the fund to participate in the rally, uncapping the upside. Daily in dynamic and daily innovation, institutional dynamic, which is the Goldman Sachs funds, right? The ticker GPIX and GPIQ. Dynamic overriding, adjust coverage from 20 to 25 to 75%. Very defensive, increases coverage to protect capital and volatility. So when the bubble bursts, they will flip over to the other side and protect themselves, which means protecting you, the NAV, right? And then it can drop down and go into an offensive mode at the same time. Drop coverage 25% to capture beta in rallies. So it can do both, right? Yes, I hold these two. These two are part of my core. They have played a very, very strong position in my portfolio because they can play both sides of the game. They can play all three sides of the game. The one is the drop down, the bear market. The two is the sideways, and three is the bull market, which is why I always vouch for them when someone comments, hey, which one would you recommend buying? I'm starting out. I always recommend these two. Their strategies is just very unique. I personally think I want to say they are better than NEOs. If I had to choose NEOs or Goldman, I would choose Goldman. And then build around it and buy some NEOs. And then among other cover call ETFs, Amplified, Roundhill. And then we have the daily resets, right? The pro shares, the innovators, right? Ticker iSpy. Daily options reset the cap on every morning. Path dependency. That just means it solved the issues of being capped out early in the month, capturing overnight beta. So it 9:30 a.m. to 4 p.m. Eastern. It resets, it buys new, resets the options, and the strike price is everything. So this can be a good thing. This can be a bad thing. It just depends on how well the plan gets executed. Quality, future, and bonds, right? We have the quality, which is Devil. Excellent ETF. It is a traditional ETF with a cover call spin. So this is not a true cover call ETF, but for this purposes, we'll call it a cover call ETF because they do use a cover call strategy, right? What makes them so good is that they're very, very defensive, right? Yes, the yield is lower, about 4.6 to 5%. Yes, that is what makes them great. Because of such a low yield, and 5% is not low in terms of traditional yields like growth that can go from 1 to 3%. 5 would be considered high in that traditional sense. But for the cover call sector, area, environment, that is a very low yield. However, that's what makes them very, very good, right? They have 20 to 30 high quality stock like Microsoft, United Healthcare. They use a tactical call writing only when technically overbought, best for crash protection. And they can ride the wave upside. So they play both sides of the game with a low yield, so they're very sustainable. They're long term. They're forever holds, in my opinion. And then we have futures, right? Value, right? Yield is 7.5%. Systematically buy futures to manage delta targets, offset short calls to ensure rally capture. So if you do want to kind of play a little bit riskier, this one, the futures, play some futures, right? For the recovery. And then we have bonds, which is the ultimate safe, quote unquote, ultimate safety, right? Bonds, TLTW, yield is 12 to 15%. Right calls on long duration treasuries, TLT. Monetize rate uncertainty, diversify away from equity risk. Right, high octane and international, we have the aggressive tech, FEPI. from Rexfang and Innovation Equity Premium. The yield is extremely high, around 25%. Febby has been doing pretty well right now. Of course, the bull market, right, since it's aggressive. Strategy, right calls in just 15 big stocks, such as Max 7 and Plus Innovation. The risk is that it's super highly concentrated in tech. Great for melt-up income, dangerous in a tech burst. International Quality, IDVO, I've talked about this from Amplified. CWP International. The strategy is international equivalent of DIVO. The role is diversification away from U.S. tech bubble while maintaining high-quality income standards. Holdings, global aristocrats with tactical overrating. Excellent international cover call ETF. All right, the strategic roadmap. This is just illustrative purposes of what I think would be a good roadmap for what's going to happen, right? The market phase, let's just say current late 2025, bubble dynamic, melt up. Recommended strategy for me: capture upside, but harvest premium. Avoid cap funds like iSpy. Sorry. Get these funds like iSpy, SpyEye. That would be my top ETF pick if I had to choose. These would be examples of some. Bubble peaks, bubble dynamic, maximum euphoria. Euphoria. Oh my, I can't say it. Ugh, I've been talking too much today. Recommended strategy is to reduce beta, move dynamic coverage that can hedge. Some of them top ETF picks would be GPIX and Bally, right? And then market phase, bubble burst, right? Bubble dynamic, crash correction, or correction crash. Recommended strategy, flight to quality. This is where we should be transitioning to right now. The flight to quality cover call ETFs. Maintain high cash flow to offset price drop, and some would be DIVO and TLTW. So those are just some that you guys should be thinking about if you guys have too much high yield, high risk cover call ETFs, or if you guys are using margin, or if you guys are using leverage ETF. You guys have to start thinking about what if the market is really going to start a prolonged downturn. So start thinking about that, guys. Protect yourself. You don't want to lose money because we don't know when a bear market will be over. And you don't want to get caught up on destroying your NAV and your payout. All right, the income solution matrix, it's just from the previous slide, right? Capture the melt up, cap upside, SpyEye, maximize after tax income, ordinary income, QQI, SpyEye, core portfolio holding, right? High fees, tracking error, GPIX, GPIQ, crash protection, capital loss, DIVO, IDVO, right? So these would be some of the top ETF solution, in my opinion. They kind of hedge against each other and protect each other. So one falls, the other one goes up, the other one goes up, the other one falls. So it's great balance. And then my verdict, right? Ray Dalio's 80% warning is a signal to upgrade your income strategy, not necessarily to exit the market. Do not panic sell. Do not see a red down, you're down 10%, 15%, and you think, oh my God, I got to get out. You should, if those are already high risk, high yield ETFs that haven't been doing great in a bull run. Now those are the time to let those go and rotate your money. The easy money of passive cover call is over. Pivot to structure, tax efficiency, and quality. Do not hold garbage cover call ETFs. If you know they haven't been doing well in the bull market, what makes you think they're going to do well in a bear market? They will get destroyed if this sell-off keeps going on for a prolonged time. Those ETFs will get absolutely crushed. I don't want you to lose money. We are here to escape the rat race. We are here for financial freedom. We are here to create a $10,000 a month minimum passive income while maintaining the NAV or growing it even better. All right, guys, start looking at your portfolio. Start thinking about which cover call ETF to rotate to if you haven't, if you need to. Don't lose money, right? That's the number one rule. Don't lose money. Subscribe, comment, like. I appreciate you guys watching the video. Hopefully you guys enjoyed it. I just want to put this together because I read his article, Ray Dalio's article, and I think he's half right, he's half wrong. He's half right that the AI, there is some sort of bubble because there is a lot of bullshit AI companies. So, that that itself is, it's going to end up being burst, and it's going to affect the bigger AI companies. But overall, I think it will do well. We just don't know how long this downturn is going to be, so we always have to prepare for it. Thanks for watching, guys. Stay tuned. Catch you guys on the next.